Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube. 500 up 15%. NASDAQ Composite up 19% year to date. Every year we have the naysayers. Oh, next year just can't live up to it. Can't live up to it. Let's find out what our next guest thinks about all of this. And our next guest is here in studio with us, Alicia Levine, Head of Investment Strategy at BNY Wealth. Alicia, is it going to be, can 2026 live up to the numbers of 2025?
We think yes, but we think it's a nonlinear year this year in the way that it was nonlinear in 2025. Ultimately, a year ago, we had a 6,600 price target on the S&P, and we're ending more or less here. We moved our target up, mid-year as the markets recovered from, peak tariff uncertainty. We're looking for 7,600 next year. We just don't think it's linear. We are looking for 13% earnings growth. Margins are expanding. And so in the end, there'll be policy noise. There'll be issues with maybe the dollar or with bond markets, as Japan is hiking. But ultimately, the fundamentals are the fundamentals. And every year the panicans tell you why this is the year that it's all going to fall apart. And what we've learned is corporate America is amazingly resilient. Think of the shocks that have come in the last 5 years. And the only thing that's happened is earnings have moved higher and margins have moved higher.
Good point.
So,
yep, but but my question then becomes, what about the job market? Because the pandemic was a once in a lifetime sort of thing. So if you take that out of the picture, unemployment hasn't been this high in years. If the market really starts to crack, does that become the big problem for the market?
So I think the issue really is the labor market here. And I think it's good that the Fed is cutting, and it's good that they restarted the cycle over the summer. I think Christopher Waller was really, frankly, far ahead on this, seeing the cracks in the labor market earlier than the official data was telling us. That's the risk here. What you're going to have, though, in the first part of the year is $160 billion coming back to households through the tax code. So there'll be immediate fiscal stimulus. And on top of that, you have about $200 billion coming towards the corporate sector for CapEx and investing. And when corporates are raising CapEx, you don't get lower employment, right? So you sustain employment when there is CapEx. I think this quarter is probably the worst quarter of the year. We're feeling the slowdown. Certainly the 6-week shutdown was not helpful. Some of that growth that we missed is going to come back in the first quarter of next year. Some of it's gone forever. We're feeling the effects of that this quarter. So there's massive fiscal stimulus coming in the first half of the year, and the Fed's in a cutting cycle.
Yeah, exactly. Alexis, Alicia is on my starting 5 of the All-American Overeducated team. Here we go. Undergraduate from Brown. Okay, that's fine. Master's and a doctorate from Chicago. Can we stop?
In philosophy.
Can we stop? Then a postdoc from Stanford, and let's do another postdoc from Harvard. Enough already. Just
come on.
Get to work. Alicia, it's unbelievable. Every time I read this, I'm like, enough already. Alicia, we had some really good earnings from corporate America this year. Second quarter, third quarter earnings have been really good. Are they enough to support this market going forward?
They're definitely enough to support the market. So again, let's go back 12 months ago. The market is trading at 21.6 times earnings. And the panicans are saying there's no way the market's moving higher because, the S&P is overvalued. We've never been this high. We haven't been this high since 2021. And then before that, it's 2000, right? So then you get the bubble talk. So what happened this year? Earnings came in at 13.5%, beating estimates by about 6% overall, driving the markets higher. And so the market's up 15, 16%, Alexis, as you said, on the back of earnings, because the multiple is only responsible for about 15 or 20% of the S&P price moving up this year. So next year, you need those earnings. If you don't have earnings, you have a problem in the market because the multiple is high. But as long as that comes through, the market can move higher here. But again, are you moving to a place where the supports for appreciation are narrowing? And probably that's the case. We can't see multiples moving much higher from here.
What about, I just want to talk about oil, because it's just fascinating to me what's been going on with oil and how you see that playing into the landscape or opportunities or lack thereof in the new year? Because the world is awash in oil, and the smart money is betting on crude oil remaining in the mid-50s, for most, if not all, of next year.
Look, I mean, that's part of the Trump administration's plan was to get oil prices down. You see agreements with Saudi, they're pumping. And so that is part of the plan to bring inflation down. And once, of course, oil prices are lower, the disinflation filters through everything in inflation readings and inflation overall in the economy. So we do think oil prices probably are moving lower here. If there is any kind of deal with Ukraine and Russia, and I know a lot of people have lost a lot of sleep over whether or not this can happen, but if there's a Russia-Ukraine deal, then you bring Russian oil back onto the market. So you're going to have, a flood of supply. And so we think that oil prices are probably tame. Whether it's 50 or lower, we're not experts in oil pricing, but, supply demand, there'll be a lot of supply.
Alicia, we've had some very nice returns in the U.S. stock markets, but boy, if you look at EMEA, I mean, 20, 30, 40, 50% gains
It's incredible.
On a currency-adjusted basis.
It's incredible.
What do you think about the U.S. non-U.S. allocation for 26?
So it's a great question. The dollar dropped 10% in the first quarter.
Yep.
Okay. And that's when rest of world outperformed massively. Since July 1st, the dollar's actually gone nowhere. It's in that stable Dixie range really for the last 6 months. So I think the question and as a result, by the way, the S&P has outperformed rest of world by about 5% since April 1st. So since the tariff shock and the recovery and tech driving the growth out of the lows, and then the rest of the market taking over since September, the S&P has outperformed rest of world since that time. But on an annual basis, absolutely, the S&P is far lagged. Okay, so what do we do for next year? I think the answer is the dollar. Like, what is your view on the dollar? If you think the dollar moves a couple of percentage points lower, then it's possible rest of world outperforms, but you're not going to see a 20 to 30% outperformance as you saw this year. The steeper yield curve is interesting because that is global, and financials are in every index. So, Japan, Europe, and emerging markets, financials are massively part of the indices. So the steeper yield curve also could move markets higher. In our client base, we're overweight U.S. That's our client base. They believe in U.S. exceptionalism, but we have a healthy allocation to rest of world, and we just raised actually our allocation in emerging markets, equity, and debt.
All right.
Yeah.
All right. What about commodities? I'm thinking precious metals. Is it going to be another standout year here? Or are they going to finally take a breather?
Unlikely to be the kind of year we had this year. I think silver is something of a catch-up trade. Hasn't moved this way in the last 25, 30 years. I think on gold, it's very interesting. There's a new factor here because it's no longer sort of gauging fiat currency and whether central banks are too liquid or not. It's really a central bank trade now because when the U.S. put sanctions on the Russian central bank, that was it. Every rogue nation or soon to be rogue nation started buying gold. And so again, supply and demand. Now there is a massive demand for gold assets, and so we do think gold can move higher into next year.
Wow.
But not the same move as we saw this year.
Yep.
You can't have the parabola every year.
Yep. The Fed seems to be in a cutting mode here. How important is that to your backdrop here?
Hugely. Like the biggest, what's the nightmare? The nightmare is, that the Fed wakes up, we have, massive growth and inflation's over 4%, and the Fed pivots to a hiking cycle. So a cutting or a waiting is fine for this market. The hiking would not be fine.
Yep.
That is not in any scenario we have, but clearly that is the linchpin to the risk of the market here.
But that would mean inflation would have to really take a leg up.
Right, it would have to.
And so far the numbers, if you believe them, don't seem to be pointing in that direction.
We're calling for inflation in the second half of the year to be much lower than it is now. You're cycling the tariff issues. You're going to be done with that by May, June. It's going to move lower. And actually, the recent CPI, I know that there have been some issues with OER and putting a zero in for the inflation month over month. But ultimately, I think the move was too large on the CPI for it to be only a data issue. There was softness all over there. And actually, housing costs and rental costs have been moving lower for the last 12 months. So maybe there's some rebound, but there is some disinflation in the system. And you're going to lap the tariff issues by the spring.
Alicia, thank you so much for joining us. Really appreciate it. Alicia Levine, she's head of investment strategy at BNY Wealth, and we appreciate her coming in to our Bloomberg Interactive Broker studio. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
A lot of economic data this week. The Eco-Go function, I was on that all the time.
Yeah,
here.
thanks to the government shutdown. We're trying to play catch up.
Try to play catch up here. So let's get a little bit of a review here and what we can think about going forward with this economy in 2026. We can do that with our friend Win Thin, chief economist at the Bank of Nassau. Win, we got labor market data. We got some inflation data. What did you take away from some of the government data this week?
First of all, thanks, guys, for having me. It's always a pleasure to be here. Look, I've seen some murmuring about, hey, there's some of this data may be kind of sketchy, it's incomplete, but, you can quibble about it all you want, maybe a tick here, a tick there, but really the underlying signal through all this noise is that the labor market is cracking and inflation is coming down. So to me, that sets up Fed easing next year more than what the market's pricing in. I would just note, the last 7 months, starting in May, we've only added about 120,000 jobs total. 7 months. The 7 months before that was 1.2 million.
Yeah.
Okay. If you add in Chair Powell's assertion that monthly gains are overstated by 60K, then we're talking about minus 300, 400,000.
Negative job growth.
So, it's and all the other sort of concurrent ADP, Revelio, all the other data really supports that. So yes, you can quibble about the reliability of this data, but I think the signal is very clear.
So the market seems to be banking on 2 interest rate cuts next year from the Fed. Powell was a bit conservative and seemed to signal 1. Where are you at in all of that?
Yeah, so I think the market's understating the capacity of the Fed to ease. Again, I'm sort of more worried about the labor market than I think than many in the market. If you look at your WIRP, one of my favorite pages, I think the odds of a January cut are only 25%, which I think is pretty low. I'd say right now, I'd say it's a coin flip, depending on, and with the deciding factor being the December jobs report that comes out in early January. So we've got another jobs report, another CPI report, 2 retail sales report. That's going to kind of, I think, inform the Fed. But really, the trend is there. The labor market's cracking. To Lisa's point, there's so many companies that are starting to talk about weak outlooks for sales, consumers cutting back. I mean, that's going to happen if the labor market's cracking.
4.6% unemployment rate. That's still pretty good in my mind, but what's underneath that?
Yeah, so I think you have to see where we came from. Remember, we bottomed at 3.4% back in 2023.
Yep.
This whole debate about whether the Somme rule is still in impact, because we're pretty much double what the Somme rule would say in terms of recession. But I think most people's base case is that we have no recession next year, and I'm on board with that. But I do think we have some slowing growth. To me, the big issue for next year is, can the AI investment boom offset what I think is coming a significant slowdown in consumer spending? That's to me a $1 million question. I think it will help offset it, but I don't think it can totally overwhelm this. The consumption. Consumption is 70% of the U.S. economy. Fixed asset investment is about 20%. So it's hard for this investment boom to really offset a big consumer slowdown.
So if the labor market is your biggest concern heading into the new year, how concerned are you that we might slip into a recession?
Yeah, so again, I think that's a risk. I think the market odds of a recession, something like 25-30% odds. I think that's probably right, maybe a little bit high. I do think that there is enough momentum in the U.S. economy to kind of keep going. I just look for a slowdown. A few rate cuts from the Fed can't sort of help. I'm looking for at least 3, maybe even 4 cuts next year. The dot plots, as you point out, at 1, which is to me just kind of silly. We know inflation's coming down. A lot of the tariff stuff is the year-over-year stuff will kind of fall off, the base effect. We know the labor market's cracking. So, again, you can always kind of poke holes at what the Fed is saying, but they're looking for 4.4% unemployment in 2026, 4.2% in 2027. I'm not sure how that happens unless we get a real acceleration.
Without a little bit of help.
Yeah, we need some help from the Fed. Again, nothing the Fed. I don't think it's panic time. I think they should be cutting, sort of front-loading these cuts.
How's the consumer doing out there?
Well, Lisa gave us a little hint. I mean, I've probably been hearing this over and over. Yes, the guidance for next year is the concerns, consumers cutting back. I'm sure you've seen all the statistics that the bulk of the consumption retail sales is being driven by sort of the high 20% sort of income bracket, whereas something like 60, 70% of the economy consumers, the lower income consumers, are struggling. We know that. That's why we're talking about affordability. For us here in this room and our listeners, we're feeling pretty okay. But really, for the majority of Americans, I think they're struggling with the inflation. Now we're getting these layoffs, tepid job growth. So it's a struggle. It's that whole K-shaped economy that we talk about. And I had this debate, is that upward K enough to offset the downward part of the K? And, that's, to me, a big question for next year.
So then where do you see, I guess, strength in the economy next year? I mean, if it's not going to be the consumer, if it's not going to be the job market, where do we see sort of because the consumer has been the pillar of this economy for so long, right?
Always is, yeah.
Who or what provides a foundation, if you will, for the economy?
Yeah. So you go back to Econ 101, you got C plus I plus G plus net exports. So consumers, cutting back. G, in terms of government spending, cutting back. We've given out some tax cuts, obviously, under the big, beautiful bill, but the actual government spending is going to be, I think, a net negative next year. Net exports, that's a tough one, given that, with the ongoing tariff war. So it's really up to investment. And again, I keep pointing to AI. That's been a big driver why headline growth in the U.S. has been so strong. It's all this investment in energy, chip production, all that. Can that be sustained? Is that enough to offset, again, 70% of the economy? Again, I don't think it can totally offset, but it'll kind of cushion the blow. And again, the Fed starts cutting rates. We get some maybe life in the housing sector, which
that would be
really
nice.
Under pressure. Yeah.
Yeah. Speaking of which, what is your outlook for the housing sector?
Yeah. So we had this nice drop in mortgage rates, as the Fed was cutting, but now they've been kind of sideways. And you look at some of the housing data. Well, unfortunately, we haven't had a lot of the housing data because of the shutdown. It's starting to trickle out, but there seems to be some sort of modest recovery underway. But again, I think the important thing, and this is, I think, what the Fed is puzzling with, is the Fed controls the short end. What's going on with the long end? And the long end has kind of stayed elevated. And that we need to get the long end down to get mortgage rates down. And we could spend an hour or two talking about that.
All right, Win, thank you so much for joining us. Really appreciate it. Win Thin, Chief Economist at the Bank of Nassau. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get a reality check now with Katy Kaminski, Chief Research Strategist at AlphaSimplex. Katy, thanks for being with us. If you had to name the top 3 trends to look for in stocks in 2026, tick through those for us. What would they be?
Well, I think the AI trend is the one that we've been following, but we have seen some broadening in the last, 6 weeks or so. So I think it's going to be about finding the winners and losers of this theme. And also we've seen a lot of interesting action outside the United States, excluding, of course, China. So I think for equities, it's definitely still a very positive signal, but we have seen a lot of uncertainty recently, just given the range of possible outcomes for next year. And I think we're kind of watching this idea of extreme market environments for next year, either really good or really challenging, depending on how things unfold.
So we've got the Fed, Katy, cutting interest rates. I guess the market's discounting maybe a couple more rate cuts in 2026. How does that kind of influence kind of the trend theory for fixed income in 2026?
This is actually something that I've been thinking a lot about. And the reason is we've actually seen yields rising more recently. Look at today, you've seen also yields rising globally across different economies such as Australia, Japan. And so I think what's been interesting is the trend signals in fixed income have actually moved to short views. So that seems a little at odds with this idea that Fed is cutting rates. So I think what we worry about is that you may have a lower short-term rate, but that longer-term rates may stay a little higher than what a lot of investors are hoping for next year, especially given the potential for inflation. But of course, this week we saw a good inflation number. We see energy's down. So that leaves us kind of scratching our heads a little bit about what will happen with the fixed income markets now that signals are very muted and even short internationally.
Let's bounce over to commodities because, gee, what a year it's been for the metals, right?
Yeah, absolutely.
I mean, commodity markets, investors have been loving up their metals. And we're not just talking about gold, silver, along for the ride, copper as well. Even though inflation is stabilizing, I guess, if you're to believe the latest numbers that we've gotten. So what's the outlook for 2026, especially if inflation doesn't really make a lot of noise for the market?
Well, this is a really interesting point because we've been watching these metals trends very closely, and they have been extraordinary this year. And what is really confusing from an inflation perspective is that, you see things that are really important, like energies that are down quite a bit this year, but you see the metal block that has moved counter to that particular theme. And so you have to start asking, what does this mean fundamentally? Is this something that could be a catalyst, or is this something that's just out of sync with sort of the inflation narrative altogether? It is concerning, particularly with copper and other base metals, because these are directly linked to industry and to production. So that would be an input to something that could impact inflation. I think there's just offsetting forces in the energies and other areas that have kind of made it less of an extreme impact.
Katy, the U.S. dollar sold off pretty sharply there in the beginning of the year when we had all that uncertainty about the tariff rollout in April. But since then, I don't know, it's kind of stabilized, maybe come back a little bit here. But I don't see any trend for the U.S. dollar other than, I guess we're just sitting here at this level. What do you think?
So this is a good point. A lot of people are forecasting a weaker dollar
Stay with us.
For next
More from
year,
Bloomberg surveillance coming up
of rate cuts. But we just haven't seen those moves come to fruition yet. We do see a lot of volatility or bouncing around against different currencies.
You're listening to
My
the
read on
Bloomberg
this is really
Surveillance
that
Podcast.
there's a
Catch
lot
us
of
live weekday
dislocation in terms
afternoons
of
from
monetary
7 to 10 a.m. Eastern. Listen on
globally, and
Apple
that is
CarPlay and
impacting
Android Auto
flows.
with the Bloomberg
And
Business
so I
app.
think
Or watch us
there's just
live on
not sort of
YouTube.
an easy narrative. I do think at some point, should we get aggressive rate cuts, we should expect a weaker dollar, but that is just not in the data yet.
And what are your thoughts, or what are you hearing from clients with regards to possible moderate, mild recession, maybe in the first half of 2026?
I think, the timing of that is going to be tricky. We do think that we are in an environment with relatively extreme outcomes. Look at China, it's in a completely different place. Australia, Japan, that, you may see swings which are extreme in both directions. The challenge for investors is to project that, yes, guaranteed there's going to be a recession. What you really need to think about is that these sort of flux in market conditions can take a long time. So maybe we could actually have strong enough growth and we don't actually see any sort of reversion or some of these concerning scenarios until a couple of months from now. So I think it's hard to predict timing on these type of events. So preparing for it may not be the right choice.
All right, Katy, thanks so much. We always appreciate getting a few minutes of your time. Thank you so much, Katy Kaminski. She's a chief research strategist at AlphaSimplex. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Very well. May be the highlight of the day. Lisa Mateo and newspapers. Lisa, what do you got for us?
All right, we got a big event on Netflix tonight. Do you know this, guys? 28-year-old YouTuber Jake Paul is back in the ring again.
Yes. I heard.
I got all the ads on my Netflix page.
Exactly.
So remember the big Netflix fight against Mike Tyson, right? That was huge. But now he's fighting a guy a little bit, bigger than he is. Okay, so it's former world Olympic champion Anthony Joshua. He's different from 58-year-old Tyson back then.
Exactly.
This guy's 36, okay, but he's 6'6". He's 5 inches taller than Paul. He has nearly 2 decades of boxing experience, 25 wins by knockout, and he's 30 pounds heavier than Paul.
Is Paul going down? I don't know.
I think he might be going down on this one. But
Who here is watching that tonight?
I so am.
You are?
I'm a boxing fan.
Oh, you are?
But
I didn't know
I just
that.
want to see him get his butt kicked. Can I say that? I'm sorry.
Wow, I did not know that.
But either way, he's going to take home around $100 million if he wins or
what?
loses.
If he wins or loses.
Take home how much?
$100 million.
Wow.
Wow. I think maybe I'll go in the ring with
I'll
this
go
guy.
in there. Holy cow.
Get your
So
butt
Netflix,
kicked.
I mean, just more sports on Netflix.
More sports. And last time I watched, like, there were a couple glitches, like,
Did
because
you
so many
almost
people
break Netflix the last bout?
Audience of 60 million households worldwide.
It's a no-brainer for Netflix to run this thing.
Yeah. But he draws the crowds. Like, people love this guy.
Used to be a social media influencer, right?
A YouTuber.
Okay. Just
He's
checking.
28, but then he found this call for boxing, and you know what? Hey, maybe he'll win. I don't know.
You gotta watch, I guess.
I'm curious to find out.
Bring us the report back Monday morning, ladies, because I am not watching.
Exactly. I'll give you the recap.
Okay.
Okay. This is a warning for travelers, right? If you're going through the holiday season, experts are saying be very careful because scammers are taking advantage of it. They're posing as airline agents, and they're taking a lot of people's money. So this is the FTC. They're calling it business imposter, business impersonator scams. And it happened. This is a Bloomberg article. It happened to the journalist who wrote the article.
Oh.
So
And I give her
basically,
credit for writing
telling
about
her
it.
story, because you're like, how could you fall for that? But she did, and she knows.
I almost did. I was
It's
planning a trip
easy,
for my
right?
family a year ago. They get on the phone with you right away. They sound really professional.
Correct.
They say and ask all the right things. And I was about to give my credit card information, and something
Really?
said, this doesn't sound
Did
right.
they call you? Did you call?
I called them because
Yes.
when you do the search, right?
Yes.
A Google search or whatever search, the fake stuff comes up first with an 888 number that looked like it was the
Yes.
airline's number, but it wasn't. So the big takeaway, go to the website of that or use the app of that airline.
I learned that on tickets. I got scammed for the Eagles at the
yes.
Sphere.
I remember that.
And the day of, I'm about to hop on to go to the airport, and I realized I don't have tickets. These tickets didn't arrive, and that was expensive. So I learned that. It was my fault. So now I just go, you have to go right to whatever.
Go to the source.
Yep,
Go to the source.
exactly.
Yeah,
All
and
right.
it's true. And she was saying, like, she called the number and the person picked up on the first ring, and she was like, I should have known. It's a scam, because usually you're waiting forever to talk to some airline agent.
Exactly. All right,
But,
Olive Garden.
yeah, be careful. Okay, so this is a sign inflation are affecting America's dining habits. So you have Olive Garden. Remember the never-ending possible, right? That's
Yes.
the whole thing. Now Olive Garden serving lighter portions, and apparently it's working. People love it. They're having trouble keeping up with demand. We're talking smaller portions, like $13 to $15. But this is something they don't even market. Like, I haven't heard of this lighter menu.
Neither have I.
Yeah, you're used to like the never-ending possible, but it's working for them. About 40% of Olive Garden menus offer this portion. In the most recent quarter, another 20% are added recently. So they say, you know what, this is working. Maybe we should keep going with this.
Because most, Europeans come over here, they say, oh my goodness, the portions are so huge
sure.
over here.
And then you go to Olive Garden, you go, wow,
Yes.
they're really huge.
They are,
Maybe a lot of
they
people
are.
were taking doggy bags home and they realized we're wasting food, or I don't know.
That's what they
made them
say.
do
And they
this.
say, it's not even like the weight loss drugs, because you think that would be a thing because people are eating less. But they say, no, it's just they can't afford.
Interesting.
big
I guess
prices.
if the food got smaller, but so did the price.
Yep.
I'm okay with that.
That's fine. Yeah.
Yeah.
Exactly. All right. Alicia Mateo with the newspapers. We appreciate that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.